Hey guys, Chad Larson with MLD. February 1st, I'm going to dive right into our February market commentary and outlook. We're going to touch on some of our positioning strategies, what's changed, what hasn't, what happened in the front month of the year. January's was pretty dry, had to get through what our 2023 outlook would look like. So there's a lot of kind of minutia to chop through. Hopefully this one's a little bit more entertaining. This is the second time I'm recording this. I thought I killed it in the first take. 23 minutes into it, realized the microphone was off. So here we go. One of the things that's been kind of consistent in discussions with clients, or some of the things we'll try to touch on, questions around what the impact of prolonged inflation has on my portfolio, GIC rates having increasing. Should I allocate a portion of my portfolio to GICs? Recession, how long do they typically last, and what part of that are we? Where are we in the cycle on that? Our positioning in and around that, and do we expect another big correction? And then one question was, is the energy trade dead? As you know, we've been overweight energy, and that had significantly created a lot of outperformance on a relative basis through 2022. And energy in Q4 was actually a distractor, a negative attribution. It hurt us as people were looking to, with uncertainties going through year end, wanting to take some profits, do some window dressing, etc. So I'll jump into a few. One I'll talk about GSEs really quickly. The amount of liquidity and cash on the sidelines is at a near historic level, and this is the first time risk-free rates of return, or the rates that you can earn and simple interest without taking on market risk, have been something that's maybe meaningful. When GICs were 1%, what was the point? Might as well be under the mattress. But GICs are still erodive net of inflation, and so maybe getting a 4.5-5% return on GIC feels good instead of stepping into the market. But really think about, you don't have to be a market specialist or genius even to kind of see, we've gone through the worst of it. At this point, after 2022, where broader indices like the S&P were down just under 20%, the NASDAQ 33, and it was the worst bond market in one single year in modern history. So why now? Why lock in? You're going to start to see, as we stabled in our January kind of outlook for the years, we did expect, along like every CIO across all the major institutions that's worth their salt, that we'd expect kind of a choppy front part of the year, and the economy to become more constructive into discounting the future recovery that we see in 2024. So no, listen, like, it depends on managing cash flows and needs for liquidity across portfolios. And we work with clients that are clearly defining what those liquidity needs are, and build portfolios in and around that. So I'm not a big proponent of locking in rates here, because the yield curve is such that you're also, you might lock in for a year, but what are our expectations around the markets over the next year, and weigh those versus a probability of achieving those. So everyone's going to have their own risk tolerance. But no, we're not loading up on GICs to log in a 5% rate of return, especially not after a year like last year. It really sets the table for some very strong performance. The recession, how long do they typically last? Listen, I think that soft landing, and I was trying to make the analogy, if any of you are an Austin Powers fan and have seen those funny movies, this is like that scene where Austin Powers is driving a Zamboni and running someone over, and that person laying on the ground, 100 meters away, is screaming, "No!" Like, it's a Zamboni. It's not very fast. This was like watching this recession come. This is the most anticipated recession ever. And so, if you've already stepped to the side and positioned a portfolio in your capital in and around recessionary environments, you can keep walking down the road. Like, if the bus, a bus is coming straight at you, and you've already stepped to the side, keep walking down the shoulder, is kind of the best analogy we can make to that. about sticking, with. But that leads us into that next part of the conversation is, what are those positioning strategies in and around that? And, as you know, we were underweight tech, we were overweight energy. There's very few people that were successful in doing this, but again, anchored in process and philosophy, our core strategies were able to navigate, very choppy markets, and still be standing. One of the things that, and then is the energy trade dead? This, I don't think so. There's always, short term. There's going to be, if I was a short term trader, I'd be bearish. If I was a long term fundamentalist, the transition into alternative sources of energy are so far out. We're still constructive, especially at these turns of cash flow and valuations and the strength of the balance sheets that we're seeing. We're not sellers. We're definitely not underweight, nor are we, grossly overweight to the, to being getting caught in a bad place. I kind of wanted to title part of this is, we're seeing, what are the macro headlines that are impacting equities. U.S. equities have moved with a high level of correlation, suggesting systemic or news related drives in performance, and we're seeing that. And I want to I'm going to put up a deck here. And again, if you're just listening to this and you're a client, you're going to have a copy of this slideshow in your email. If you're not, feel free to give us a call and we'll see, how we could, try to get you a copy of it. But listen, markets have not been this driven, macro driven to news since the great financial crisis and Eurozone crisis. So something in a measurement called intra-portfolio correlation, let's call it IPC. It measures the propensity of stocks within a portfolio to move together with high levels of implied systematic risk. And we're basically saying is that when IPC is high, it's just news that moves companies, not their individual results. It's headline things like the Fed cutting rates or a war over here, you name it. IPC has been elevated due to dominant macro headlines, inflation, Russia v. Ukraine, etc., but has recently started to roll over. Historically, when 90-day IPC is over 50 and then has fallen over 20 consecutive days, forward 12 months returns have averaged 24%. You can see in this chart, macro news driving equity performance. It spiked and breached 50. We're in the sixth time, but number one, the great financial crisis over in 09. Number two, great financial crisis through to 2010, kind of the onset. And then kind of as things started, working themselves out with things like Lehman finally tapping out, quantitative easing, through 11 and 12. When this rolled over, the markets took off. The pandemic, the IPC, it was just basically every time the news cycle went on, markets moved. And then inflation, which is where we are right now. And so that kind of average return of 24% is definitely something to see. So markets are being driven by the Fed, and the Fed did hike today 25 basis points, which was expected, and we're kind of getting through the near to the end of that. So listen, a recession is going to happen and the market will have moved higher even through that. Markets move ahead of economic data because we are forward looking. A quick touch on it, it's, some guys I talk to, really love to talk about interest rates, and it's important. But listen, real rates were deeply negative, but we're rising, and the real interest rate is the Fed funds rate minus CPI. It plunged, kind of bottomed in March of 22 at negative 8.4, and to combat that, the real rate being Fed funds rate minus CPI, the only way to get that equation to balance is to raise hike rates. So we saw the fastest and most drastic hike tightening in history. And, now we're, through 4.25. Those were again compounded and caused, more air to come out of the market with related to kind of pandemic related supply disruptions, a high US dollar, the kind of headwinds of a very valuable U.S. currency when conglomerates are selling their products in other currencies. But again, we're starting to see neutral real rates possibly next year sometime, and looking through, is it March, is it June, is it November? But it's likely that we'll see neutral rates. And at that time, you'll see the Fed start to pause and eventually start to cut. What we want to be, and kind of the thematic where I'm going to end this conversation, isn't around contrarian thinking and being ahead of. Contrarian is just saying, the opposite, and eventually you're right. But being ahead of consensus is critical to outperformance. And the same thing. It was 2 Decembers ago we went from underweight to overweight energy. It was kind of in the September before then. We started to trim exposure to tech. Being ahead of consensus is the number one contributor to outperformance, or dodging bullets, so to speak. Something we've talked about over the last number of months. Low levels of risk taking, stocks traded at rising absolute discounts. We saw last year at one point 12% of the Russell 3000, which is a big index, trading below value of cash. Companies that were trading below their value of cash on their balance sheet and short-term investments. Those spiked during the tech bubble and global financial crisis, but we saw it hit almost 10% last year. So according to July, the data is a little old. Global fund manager surveys, PMs were taking the least amount of risk since Lehman collapsed in '08. Listen, this was inflation. This is economics, kind of third year economics, to kind of walk yourselves through the other side of this. This isn't global contagion between multiple institutions, countries, and synthetic derivatives. This was something that the wood to chop is choppable. So when you see people taking no risk, you see people hoarding cash, and you're seeing markets driven by news, that can tell you that the minute the news starts to change, the markets can surge. We also talked about, listen, portfolios are, should be treated like taps, not light switches. You can't turn them off and turn them all on. The circuits end up breaking. You're always going to try to have a certain amount of beta exposure and tilt your portfolios in and around being a market participant. Because for those sitting on the sidelines, the S&P was up 7% this month. Bonds rallied, preferred shares rallied. Listen, if every month could be like January, it would be gold chains and jet skis for everybody. But another point that's keying us, and to be, completely transparent, we had a phenomenal kind of January, and we were actively deploying, putting into practice, anchored by process, philosophy, and having great people, is leading to kind of marching things forward. But we saw low levels of hedging. That indicates strong positive performance. It peaked, and I actually re-listened to it. I don't know why. I drive my kids all over the city, and I'm stuck in my car in the evenings. So I was re-listening to my October podcast, and I talked about how hilarious it was to see, an industry record, a historic amount of puts being bought, buying insurance, so to speak, in October, when the S&P at that time was down 25%. People were, it's kind of like buying insurance on your house when it's already burnt to the ground. There was really no point. And generally that's the kind of leading indicator, because people, were tapping out, crying uncle, giving up. For us, again, we've got discipline and process anchoring how we deploy capital. We started to get constructive, starting to roll up our sleeves, picking up our pens, and looking where the opportunities might lie. So we saw, a big spike. And listen, every time the CSFB, which is the Credit Suisse Fear Barometer, it measures the aggregate amount of hedging investors have engaged to quantify market volatility. When it's higher rising, investors are buying to protect their portfolios, to protect against downside. But when the index is low or falling, investors aren't hedging anymore. There's nothing left to hedge. They've hedged out all the risk, or they're not scared anymore. This has been a good indicator to strong positive returns. In fact, when the index bottomed 20% or below the past 20 years, the S&P averaged 25% forward 12-month returns. So again, through this chart, you're talking about the low CSFB, maybe a very positive indicator, and keying off of that, we are actively deploying. I am not saying there's not pockets of volatility and a little turbulence along the way. There's going to be lots. But you got to be in the fight. You got to get to the destination. It means you got to be in the air. I think when I filmed this an hour ago, when my microphone wasn't on, I somehow ad-libbed the analogy of, boats are made to get wet. Like they're just, hopefully the boat's built correctly. So I don't know how this time I made some commentary around an airplane, but I am headed to London tomorrow for the weekend to have a couple meetings, see a great friend and client of mine. I'm back on Sunday, so maybe I'm getting anxious about getting in the air. Next, again, I'm going to do a little bit of the kind of talking about what I mentioned earlier about staying ahead of consensus. It's a great quote from Bill Walsh, NFL Hall of Fame coach. He coached the 49ers from 79 to 88. And he said, if we're all thinking alike, it means no one is thinking. I'll leave it on the deck for people to read so that I'm not sitting here practicing my reading skills. But some great analogies in and around football. Super Bowl's next week. Go Eagles. So that's my call on the Super Bowl. But in the context about investing, and being a contrarian, there's a great literature if you ever like reading about stuff like this. Google Howard Marks, Moaktree, absolute brilliant investor and brilliant investment mind. And he talks about, in the context of investing, about first level and second level thinking. First level thinking is simplistic and superficial, and just about anyone can do it. All the first level thinker needs is an opinion about the future, as in the outlook for this company is favorable, lest the stock will go up. Second level thinking is deep, complex, and convoluted. And, he writes, at the beginning of the year, and this is something we echoed as well, the consensus expectation was for a recession. And in fact, according to the Fed's survey of professional forecasters, this will be the most anticipated recession in history. So when you see overwhelming consensus, a reaction is to either buy into it or resist it, and thinking about where that consensus view, it's definitely herd mentality thinking. And I'm not saying we had a better forecast. I'm telling you that you can't anchor on this. And when you look at going back 2018 all the way through 2023, the variance, the consensus forecast, the variance on average has been 16%. So the market expected 8. It was 16% on the other side. Those are very wide. Those aren't margins of safety. Those are wild bands of standard deviation. So, forecasts are one, but where are these thematics and consensuses? Another great chart. This was, again, this is the fourth year in a row consensus. Like last year, consensus was like 6%. The market was down 20. So, no one's tarred and feathered these forecasters and fired them. It's just forecasting is just forecasting. It's effectively, and we don't even have satellites like weather people do. So, history suggests a positive move in 2023. Whatever your forecast is around earnings, we're expecting better times ahead as equity investors. The modest 6.2% forecast would be the fourth year in a row where the beginning of the year consensus is between 0 and 10%. This distribution chart will show you that only happens 16% of the time. What occurs far more frequently, particularly after a negative calendar year, which was last year, are strong positive returns. There's only been twice in the last 85 years where you had back-to-back negative years. That was World War II, the early 70s, and the tech bubble. So conversely, out of the 15 instances that we had positive return following a negative year, so again, what we're calling for a positive year, 12 out of the 15 times, returns were 20% or more. So we're constructive. We are participating, and we're very excited. People are asking, what are the opportunities today as it relates to consensus estimates? Are they too high, too low? Well, who cares? Let people make forecasts. Earning estimates have clearly been declining since reaching peak last year. And we talked about this early last year. You were seeing rising earning estimates and stock prices crashing. And the inverse is happening. You're seeing stocks rise and earning estimates being cut. Again, we are forward looking. So while earnings estimates were rising and stocks were going down, it's because the market was looking past, this front quarter. They were looking, 3 quarters out, 4 quarters out. So this reversal has been happening already. So since the market is typically market equities typically bottom before estimates do, we believe stocks can rally in the face of these falling estimates, as they've been doing in the past 3 months. And January is a perfect example of that. Opportunity side, the reopening of China's economy from the last few years of a zero COVID policy will be a driver for certain sectors. Still very constructive on energy, metals, materials. We've been talking about gold. We've included it in our core portfolio strategies. And, I had a few clients call and say, I think we missed it. These are clients maybe not on model that are more do-it-yourselfers and look for, some guidance along the way. But, being ahead of consensus, buying some of these things when not when they're so much out of favor, but when there wasn't a lot of momentum, conviction, and fanfare, that's where the risk was. So yes, maybe we're up 30, 40%. And I can't talk about individual securities because of securities laws and being a podcast. But one of our gold picks is up strongly that we own across model portfolios. And an investor said, "Well, it's too late now." Well, now that there's conviction and now that there's clear line of sight to higher gold prices, investor sentiment's improving, you can see you can see an easier double. And I kind of argue to say the probabilities have increased such that, albeit the return profile becomes skewed, it's a better investment. The other thing too, and I didn't talk about this in my refilm, was we've actually added duration. I know it's a bit controversial. If you own 30-year bonds or long durated bonds last year, you got you know you got it handed to you bad. Eventually, the yield curve will normalize, and the in our fixed income bucket, the delta between 1 year rate of return on a simple short bond or a 30-year is pretty flat. So I'm not giving up a lot of opportunity set. But when the yield curve normalizes, you could see very strong. So it's a tactical pivot that we've done in our tactical fixed income sleeves, that I think should pay out well. So we've got some rate reset content, some short corporate, high yield, some global bonds, under par, kind of out of favor, and then added 30-year treasuries to that mix. So that's something we talk about. One of the things we have always discussed with clients, giving investors a good experience and thinking differently, is delivering on this promise is no small task, for an active manager, portfolio manager, wealth advisory firm. And it's no small task for you as a client to determine where to invest. Mentioned on the talk some of the screening things we would look at, when we interview other managers and capital partners that we align ourselves to help us navigate the capital markets and invest on behalf of our clients and ourselves personally. Things like the size of the fund being too big or too small. Do they have skin in the game? Risk controls around pay for performance, number of holdings in the fund, the tenure of the portfolio manager, having a safe environment for the equity team to express their opinions, the diversity of thought leadership. It's not just one guy, calling all the shots. It's this collaborative environment, which is ultimately represented by starting each day with a white paper. We don't know what we don't know, and a high level of, EQ, an emotional quotient of being able to listen and learn, plays an important role. But thinking differently, again, kind of wrapping things in and around, thinking differently than consensus is another one of those critical ingredients in order to have differentiated returns. And consensus changes every year. Shout out to John Maynard Keynes. Studied him in economics. I think you would all know or don't know, but I'm an economist by background. Wrote about determining beauty contest winners in 1936 and whether he thought the same principle was at work in order to be as successful in the stock market. For the beauty contest, it's about picking the person who you think the judges might deem to be the winner, and not about what you might think the winner is based on your personal biases. For the stock market, it's not about what you think a fair price is for security, but rather what others, investors, might believe the security is worth. And it's something you have to reread and think about a lot of times. And, we have to kind of tear through some of our investing biases all the time. We get kind of like moths to a flame, things that feel good. But just because you think it's something valuable. And even, even great companies are not great investments. We're looking for leadership. We're looking for um, kind of trends and momentum, and being ahead of that consensus and able to allocate our capital. Um, it's kind of one of the things we kind of like all I want to talk about. Looks like my time is online from where I recorded last. But again, people have de-risked portfolios. Markets aren't hedging as much. We're almost seeing, I was speaking with a small cap manager today, shout out, he's still alive. But he said to me today, it feels like my stocks are crawling out of the ooze. I died laughing because it almost feels like there's a bubbling risk trade. Growth names that we had conviction to are, leading strong performance into January. Again, repeat January every month, and things again are gold chains and jet skis for everybody. But everyone's done hedging, or there's no risk left to hedge. There's a lot of liquidity piled back in the market. Don't go lock in 5% for 5 years. We're going to be structurally setting up this next run, and I think with prudency and pragmatism, we're not having to reach so outside and buy these wacky tech companies that had no earnings and no even near-term revenue that continue to go up and up and up and up. There's quality companies, single turns of earnings with free cash flow and great balance sheets. And I'm so excited. But again, as always, if you have questions or comments, lob them into myself. You have my email, or any member of MLD Wealth. And again, thank you so much. It's an absolute pleasure. And we appreciate that trust and confidence that you've given to us to help you navigate the markets and protect, grow, and preserve your family's legacy. Thank you, and have a wonderful month.